Welcome to this next in the series of investment in shares, and this time I'm going to look at the right time to buy, so using charting to help us with our timing. So the key principles of market timing to improve your retirement super are to buy a dip in the early stages of an established trend, or secondly to buy a reversal at support for quality stocks, and we went through that in video 2, that are below fair value. And that's just about it. You're not really looking for anything else. Technical analysis is not rocket science. It's an art. It's a skill that you can learn. But they're the two simple things that we're looking for. Now, they're not guaranteed, these signals that we get, but they do provide a massive edge for those that know how to interpret them effectively. So let's have a look at those two particular types of entry signals. So this is a stock, Regis Resources, and it's had a terrific run from around 20 cents to about $5.50 at the moment. And you can see that I've marked all the points here where the price has basically retraced or done a little dip and come back to this red line, which is a 50 period moving average. So each time the price dips to that level, it tends to find support and moves higher again. You can see there's just been half a dozen entry signals until the price actually got a little bit too far advanced. The second type of entry signal is when the price goes down to support and reverses. So we can see here with this stock Monadelphous that we had support at $5.90 from some previous lows, so some previous times that the market had found support here, and the price had risen and then fallen back to that support level, and sure enough that turned out to be a pretty good entry point. So we're looking for evidence of support holding and the price reversing and heading higher. And that investment run there went from around $6, got as high as $16 before coming back and testing support again on two occasions at around about $12.20. So again, another entry opportunity here, because clearly the price is demonstrating that it's probably finding support. And we had another run from around $12, got up to about $22, and again came back to support at around 17 before advancing again. So really they're the two broad, simple entry criteria that you can use for helping with improving your timing. So just a reminder, this is general advice only. Now let's have a look at market cycles, because understanding market cycles and the natural rhythm of the market is very important to gain that extra very large edge. So all stocks and markets tend to move in waves, and they move within 4 clearly defined phases. And those phases are very much created by crowd psychology and their resulting behaviour in the marketplace. So they're the 4 main phases of crowd emotion. So phase 1 is generally after there's been a significant decline, and there's generally little interest in the stock market at that particular time, or in that particular stock. The people that have been in it have been burnt, and they don't really want to know too much about stocks at that point in time. So the price tends to consolidate in a flat band, and we'll have a look at this on a chart in just a minute. We tend to see spikes in volume showing up when the inside smarter money starts to buy when they know or perceive that there's great value to be had in buying at that time. So that's phase 1. It's generally a fairly quiet period, price going sideways, not much action except for these odd price spikes. We then move into phase 2, where most of the former selling from previous highs has been done, and so the smart money has to start paying higher prices to buy the quantity of shares that they desire. So prices start rising because we've got more buyers and less sellers. And this is the start of the bull market phase that accelerates partway through. And that's really the part that as investors we really want to focus on. Now inevitably the price tends to get overextended and and the smart money starts to exit at that point. And again, there are some very telltale signs of when that's happening. It's very easy to spot in the chart if you're watching. And it usually causes unusually sharp movements in both directions. So we get a sudden move down and then we'll get a sudden recovery, and it's generally quite a volatile period. And it almost always forms a secondary peak. So if you know what you're doing in the market, once you've seen the first sign to get out, and maybe you haven't quite got out quickly enough, don't panic and dump all your stock at the first decline in the market. There's almost always a secondary peak which gives you an opportunity to get out at a better price. And then we move into phase 4, which is really the main decline phase, as prices come back from being overbought, having been too expensive, and they start to form lower highs and lower lows and form a downtrend. The smart money gets out early, everybody else hopes it'll be okay and hangs on, gets more and more despondent, and tends to exit towards the bottom as they give up hope. So here it is in graphical form. You can see here over towards the left hand side we've got the phase 2 bull run in this particular stock. It's a gold stock, and the price moved from around $1.60 to about $3.80. We then started to get some fairly wild swings, as you can see, in phase 3, with significant decline, a little bit of consolidation, then a big recovery, and then eventually the price started to decline again. And you can see that we got a real last gasp panic sell-off towards the end, and this was in 2011. And we then consolidated for a period of time. We got a little bit of a rebound. We then consolidated in another phase 1, and then phase 2 started just a couple of months ago, and the price has risen from around about the $2.50 mark to about $3.70. So using these techniques really do give you a very, very significant edge as an investor. So obviously it's the phase 2 entries that we want to focus on, and there's two ways to do that. One is to buy at the breakout. Now that's the best place, but it's the hardest to obtain unless you're already watching the stock, and you're already watching the stock on almost a daily basis. The easier place to get in is to buy after the first pause or the first pullback in price, and that normally occurs 3 to 10 days after the trend starts, because there'll be some selling, short-term traders taking some very quick profits, or old owners of the stock that may be bought at a much higher price and are keen to get out at a bit better loss than what they had just a few days or weeks earlier. So we can take advantage of that emotional activity by just recognizing that that's how the crowd actually behaves. So there are our two entry opportunities. And after that first pause or pullback, it really sets up the largest and fastest part of wave 2, of phase 2 I should say, and that's what we call wave 3. So looking at it here in Silver Lake Resources, looking at this recent rise from around the $2.50 mark to the current level, and you can see that we got an initial run higher from the panic sell-off. We then got a bit of a decline, bit of a pause phase, and then this was really the entry here where this green circle is showing the entry at probably around about the $2.90 mark was a pretty obvious entry level for investors. Now I believe this stock has got a long way to run yet, but that's certainly given you a very, very significant edge, whereas most people really aren't looking at coming back into the stock until the media started reporting about how well gold stocks were doing up around the 350, 360 mark. So this is a technique for getting in a lot earlier than what the general public is. So looking at buying the dips, there are several ways to do that in phase 2, and you need to plan an approach that works most of the time and stay with it. I see too many investors who keep chopping and changing the way that they enter and exit their investments. So plan it out in advance and stick to it if it's a robust strategy. The other thing that you may do is to choose to buy in portions as the trend unfolds. You don't necessarily have to put all the money in at the start. You can just buy progressively as the trend unfolds. Now, what I can say is that the conditions for a significant market decline are really absent at this time. I know a lot of investors are still a bit nervous about what's going on, but I really can't see the factors that are going to cause the sort of declines we saw in 2010 and 2011. Yes, the market will swing from being overly pessimistic to overly optimistic, but the main drivers are pushing certain sections of the market higher, and those certain sectors and how to exploit them are what you need to know about. And you need to know about it quickly because this is happening right now. There's a well-proven approach to this that I've been teaching now for about 12 years, and that's what I want to give you access to. So if someone else manages all your money, or you're sitting heavily in cash, you urgently need to see these videos. So you need to go to specialistshareeducation.com.au, and if you fill out the form there, then I'll be able to send those video series to you. Cheers.